Are you wondering how to generate income with options? Well, stick around because today I'm going to explain to you exactly how you can start earning a living like so many other people do trading options. Hello, my name is Rick Orford, and I've been trading stocks and options for more than 20 years. Actually, my journey on YouTube started with explaining how to trade put options to earn income, and it's still my most popular video today. Anyway, I found the beauty of options is that unlike stocks, you can get started with a small account and you can earn income in any environment. What does that mean? It means it doesn't matter if the markets are going up or down, there's money to be made. The key is knowing what you're doing and, of course, setting yourself up for success. Now, there's several strategies that you can use to generate weekly or monthly income by buying and selling call options, put options, or a combination of both. Today, in this video, I'm going to show you the 7 most important options trading strategies that you need to know so that you too can create a steady weekly or monthly income right from your home or on your cell phone, from the beach, or wherever you have an internet connection. So stick around because you're sure to learn something new, some new safe ways to make money trading options. And if anyone said that trading options is risky, well, I've got you covered because every strategy in this video explains how to minimize any chances of losing money while maximizing the chances that you'll be profitable. And by the way, if anyone ever asks how you know all this information, just tell them that you follow Rick Orford on YouTube, right? Okay, so let's get started. All right, so first up we have covered calls. Covered calls are a really popular option with stock and option investors because it's a super simple way to generate income on assets like stocks when prices are moving downwards or sideways. Now, brokerages will approve almost anyone for covered calls if they haven't already done so for you. So there's 2 parts to the covered call. First is buying or owning the asset that you want to use in multiples of 100. And this is because option contracts are always in multiples of 100. It's kind of like owning 100 shares of Apple. If you sold a covered call, it would be 1 call option. The second step is writing or selling a call for every 100 shares that you own. You'll then receive a premium for that call that you wrote. And this is income that you get to keep. It's as simple as that. Now here's the secret to selling covered calls. The key here is to have the option expire worthless. This way, you can write another call next week, next month, and you keep earning more and more income. Now, you might be wondering about the risks in selling covered calls. The risk in selling covered calls is that if the stock price ends above the strike price, well, the option is going to get exercised and you're going to sell your shares at the strike price. And that's how an call option works. Now, sometimes this is perfectly fine, it's exactly what you want, but other times it may not be, and that's the only risk. Now, have you already thought about opening your brokerage account to see what stocks you could sell options on? Well, either way, when I started learning about this, I got really excited. But what I didn't know is that I still needed to figure out the details, like which company I wanted to buy if I didn't already own it already, and of course write calls on. Not only that, option details like the strike prices and expiration dates, these are all really important. Remember, the key is for the option to expire worthless, and I'll help you figure out exactly how to do it. Now, most investors will probably guess or gamble, but that sort of thing only lasts so long. To sell covered calls correctly, you're going to need to use an option scanner to give you an edge. So here's how you do it. My favorite option scanner is Option Samurai. By the way, I've left the link in the description below for a free trial and a little discount so you can try it out without any risk. Anyway, once you're logged in, go ahead and click Compose New Scan. This will show you where you can choose your preferred option strategy. A covered call is the default strategy to begin, but you can change that by clicking on the drop-down beside it. As you can see, there's a lot of option strategies that you can use to earn income, and we'll cover them a little bit later. But for now, let's stick with covered calls. Here, we can use filters to customize your searches. Remember, you want covered calls to expire out of the money. We want them worthless. So let's look at the filters that are available and go straight to the probability of expiring worthless. If you click on the filter, you'll see a slider, and this indicates the probability range from both ends. For example, I can set my preferred probability to over 80. And again, the higher the probability of expiring worthless, the better the chances you'll be at being profitable. And at the same time, just be aware that the more chances of being profitable, the less you'll earn. I mean, right? It's all about risk and reward. Now, I'll put the slider right to the maximum that the search will give us. At the time of the recording, the top result here is Tesla Incorporated, and the scanner tells you everything you need to know about the trade. If we click on Tesla, the details page appears at the bottom of the screen. Here we have 3 tabs: Strategy, Stock, and Options. For now, we're going to focus on the Strategy tab because this is the trades that we need to make. Okay, so here you've got everything you need, from what kind of trades you need to place with your favorite brokerage, to the strike prices, as well as the expiration dates, in addition to expected profit and loss scenarios. According to the scanner, for this trade, you can buy 100 shares of Tesla for $259.67 and sell a $285 strike out of the money covered call for between $2.58 and $2.63 a share. And I'll assume you got lucky here with the higher value, so we'll go with $2.63 a share with the $2.85 strike price that expires on October 20th. And by the way, that's just 10 days from today. Now, let's take a look at how the strategy might play out. This covered call gets you $2.63 per share, or $263 total for the contract in initial premium, which is not bad considering the option will expire in only 10 days. And this is income that you get to keep no matter what happens to the stock. Again, you can write as many consecutive covered calls as you want, week after week, month after month, and heck, even day after day in some cases, as long as your call option isn't assigned. Now, what happens if your call option is assigned? Well, it'll happen in this case if Tesla's price goes above $285 or higher before expiration. And if it does, well, you still profit from the trade. And the profit can be calculated by taking your purchase price, which is $259.67, and subtract it from the $285 strike price. So here you make $25.33 a share times 100 times the number of contracts sold. And for one contract, that works out to $2,796. That's not bad in only 10 days. Give me a like on this video. So you see, the premium you receive initially is added to any profit that you receive if the call gets assigned. Also, be aware that no matter how high the stock goes, even to $1 million, if you get assigned, you're going to get the strike price. Now, say we want to exit both the stock and option positions and don't want to lose any money on the trade. In this case, you're going to have to buy back the same call option that you sold and then sell the shares. Assuming that you can buy back the call option for, let's say, $1, You now need to sell your shares for at least $258.04 a share to break even. And remember, this does not consider any trading fees or taxes, so be mindful of those. By the way, Option Samurai gives you a break-even price of any trade by checking the profit and loss, or the PL profile, on the details page. It's shown as the dashed line or the dotted line, but it doesn't take into account, closing out the option. It assumes it expires worthless. A loss on a covered call is only fully realized when you sell the stock at a lower price than what you bought it for. This is calculated just as any losing stock trade would. For example, let's say you bought a stock for $100 and sell it for $90. Well, that's a $10 loss. So don't set the strike price below what you bought the stock at. Of course, if you do end up selling the stocks for less than you paid, any actual loss that you take while you're covered is offset by any premium that you received for writing the call, because that's yours to keep forever. So let's say Tesla's trading price drops to $250 and you decide to cut your losses. Well, in this case, you'll have a loss of $704. Now, if you want to know more about covered calls, check this video up here. I broke down the topic in far more detail for you to check out. Next up, we have cash-secured puts. Cash-secured puts, or naked puts, mean selling put options and collecting an income as a result. Selling puts work well when markets are moving up. Actually, from about 2012 to about 2020, selling puts on the S&P 500 was an incredibly popular and profitable trade. Thing is, you need enough cash reserves or margin to purchase whatever it is that you're selling the put option on. So if you're assigned, you'll have to buy stock or the ETF at the strike price. And the stock might be trading at a lower price than the strike price. So you need to be aware of that. You'll want to sell puts on stocks that you expect the trading price to stay above the strike at expiration. And if you do it correctly, you can generate a pretty stable weekly or monthly income. Now, I touched on assignment, and maybe I was a little negative. One of the benefits of selling puts is that options can get to buy stocks at a predetermined price, and that's the strike price. And that can be a good thing if you want the opportunity to pick up a stock at a discount to today's price. Of course, it could be a bad thing if you're caught off guard and you're forced to buy something that you don't really want. So if you're going to sell put options for the income, be sure to do them on stocks you'd actually like to own. Okay, so like before, we can scan for probabilities of put options expiring worthless. As you can see, I'm back here in Option Samurai and I'm looking up naked puts because that's what we're selling. And remember, we want a minimum of 80% chance that this put option is going to expire worthless. Now, by the way, you can set it for less, but it makes it a riskier trade. I don't suggest taking on any extra risk that you can't afford. Now, let's say you're bullish on Google and you see this in the list. This is the $130 strike that expires on November 10th. And as you can see, there's an 81% chance of the option expiring worthless. Putting it differently, pardon the pun, there's an 81% chance that Google will remain above the $130 strike by expiration. Now, if you sell this put option, you'll collect $142 for the contract, and if it expires worthless, then you can sell another next month or next week, whichever. By the way, remember, one of my first videos was about selling put options. It's my most popular one. So if you want to know more, check it out right here. Okay, so as long as the put option expires out of the money, you can sell another put option and collect the premiums again and again, just like you can with covered calls or any other income strategy with options. So that means you can earn money every time the put option expires worthless. Now, if your option does get assigned, here's what's going to happen. You're going to be buying the stock or the ETF or whatever it is, and you're going to become the proud owner of 100 shares. In this case, 100 Google shares for $130 a piece. And that's a 7.3% discount from the current trading price, at least when I recorded this video. And don't forget about the cash secured part of cash secured puts. You need to have enough money or margin to buy 100 Google stocks at $130 each in your account for as long as the put option is active. All right, so similar to a covered call, the break-even price for cash secured puts can be calculated by taking the strike price and subtracting the premium received. In this case, it's 130 minus 142, and that's $128.58. The moment the asset price drops below the $130 strike price, well, now your option is in the money. Be careful here. Now, this is great for the person who bought it, but it may not be exciting for you as you could be assigned. If your put option is assigned, you're going to be buying 100 shares of Google, and you're probably going to end up paying more than what they're currently worth. But don't panic. It's not a big deal. They're just paper losses. For example, Google stock drops to $125, and the buyer exercises their put option. Well, then you're going to have to buy 100 shares of Google for $130, which means your account will immediately show a $5 per share unrealized loss. Now remember, you only realize a loss when you sell your shares for less than you paid. In that case, any difference between the $130 and the selling price multiplied times 100 will be your gross loss, and that excludes, of course, any taxes and trading fees. However, remember, you did earn a premium from the put option you wrote, which can offset any losses. Next up, we have bull put spreads. Bull put spreads involve buying and selling put options with the same expiration dates, but different strike prices. And I love spreads because you can sell them with very, very little money. Directionally, this is a bullish strategy. So you want to sell a bull put spread when markets are moving up, and that's where the word bull comes from. The point of a bull put spread, also known as a put credit spread, is to collect premiums and be sure to limit losses. The nice thing here is that oftentimes the risk of loss is really low, like $50, $100, $200, something like that. Now, considering spreads have two legs, or two options are attached, here's a little chart to remember the strategy's two legs. All right, so let's go back to Option Samurai and search for a bull put credit spread that could turn out to be profitable. Again, all you need to do is click on the drop-down menu for the strategies, and now we're going to choose bull put spread with credit in brackets. Here we have our results, and let's go ahead and pick AMD Incorporated. This time, for this trade, it's trading around $107. According to the profit and loss, we can write a put option with a $102 strike price for between 97 and 99 cents. Then we need to buy another put option with a $100 strike and pay a premium of around 62 to 64 cents. And this creates a $2 wide spread. And the width between the two strike prices, well, that's the width. Both options expire on October 20th, which is in about 10 days from now. Let's break down this trade. Like I mentioned earlier, selling put credit spreads earns you premiums. The maximum profit happens if the stock price stays above the short put's $102 strike price on or before expiration. And that's where the name bull put spreads comes from. The credit can be calculated by subtracting what you paid for buying the put from what you receive for selling one. In this case, it's about 35 cents per share or $35 per contract at the midpoint. Since we don't already know what the actual fill price is going to be, the midpoint is usually a best guess for the premium that you could collect. Now, the distance between the stock's current price and the strike price dictates how much premium you're going to earn with the strategy. If you're a risk taker, you can always set the strike price closer to the stock's current trading price, which will net you more upfront premium, but it comes at a higher risk. Speaking of risk, the maximum loss in a credit spread is the difference between the strike prices minus any income that you earned. So in this case, the short put strike is $102, the long put strike is $100, so the maximum loss is $2 minus 35 cents times 100, and in this case, it works out to $165 a contract. In other words, you're risking $165 to hopefully collect $35, and according to the odds, in this particular trade, there's a 79% chance to keep the entire $35 premium. And remember, you don't have to limit yourself to just one credit spread or just one option trade. You can do this with 5, 10, 20. You can do this many, many times over and over. If you sold 10 of these a week, for instance, you'd collect $1,400 a month on this trade alone. Not bad, eh? A bull put spread's break-even price is calculated by taking the short put strike price and subtracting the premium received. So the break-even price on this trade is $99.65. Honestly, though, with spreads, I would say just leave them be. It's better to let them get to expiration, because fiddling with them or adjusting them can cause you to overtrade, pay more in commissions, and that means losing more money. So think of it like a set it and forget it. Since we're dealing with puts, ideally, we don't want AMD's price to drop to or below the long put strike price. That's where the maximum loss for the trade happens. But as I said earlier, the really good thing about spreads is that their losses are low. I mean, they're limited to the width of the spread, less any income that you received in the trade. So, which in this case, it's just 160. All right, so similar to bull put spreads, you can also earn income by selling bear call spreads. Now, this time, however, we're going to be using call options instead of put options. Now, directionally, a bear call spread is bearish, meaning this works really well when markets are moving lower, hence the word bear. Right now, bear call spreads are pretty popular, and incidentally, they're all poor man's covered calls. But the real term is actually a bear call. Actually, I don't even like the term poor man's covered call, because I know a lot of very wealthy people who trade thousands of these credit spreads successfully. But anyway, yeah, none of them are really poor. Well, at least not that I'm aware of. All right, so we're going to find a company now to showcase as an example for a bear call spread. As usual, I'm going to set my profit chances to over 80%, and that's because we all like to make a profit, right? Give me a like on this video if you like the idea of earning profits. I mean, who doesn't? So yeah, profitability is key, because I don't like to lose money, and I don't think you like to lose money, and I like an 80% chance or higher of being profitable. All right, so look at this. Now you see, this is a good example of not always finding ideal trades. In this case, we don't have a long list of trades to look at. And at the moment, there's only one target, and that's Chipotle, and that's trading at $1,823.51. So let's select that. And we'll see now that The scanner wants us to buy the $2,045 strike option and short the 2040, and both options expire on November 10th. Now, let's talk about how this trade could possibly go. A bear call spread's maximum profit happens when the asset price stays below the short call strike at expiration, which in this case is $2,040. The maximum profit can be calculated by taking any premium that you receive and subtract it from any premium that you pay, and then you multiply it by 100. As we saw earlier, the scanner gives us a range of premium prices, so we're going to take the maximum values to compute for profit. This means we could get about $190 for the trade. To find the break-even price on a bear call spread, you'll take the short call and add any net premiums received. So that means $2,041.90. But again, I don't suggest you adjusting these type of trades. It leads to overtrading and high commissions. Now, since this is a bear call spread, the maximum loss on the trade happens when the asset price of Chipotle reaches or goes above the long call strike price, which is $2,045. And similar to bull put spreads, the maximum loss is calculated by taking the width of the spread, which is $5, and then subtracting any premium we received times 100, and in this case, it's $310. All right, so far we've been discussing income strategies with one or two options legs. Let's kick it up a notch and combine the last two we just discussed into one strategy, and that's called the Iron Condor. The Iron Condor option is an advanced trading strategy that options traders use to generate income while limiting potential losses. It involves simultaneously selling both a bear call spread and a bull put spread on the same underlying asset with the same expiration date. Now, this works really well during times of low volatility and sideways market conditions, when it's going nowhere. And that's when the underlying asset price remains in a specific range. In other words, for an Iron Condor to work, we don't want any big swings in the stock. Iron Condors have 4 legs in total, with the short put and call strike price setting the maximum profit zone, and the long put and call indicates the maximum loss levels. Typically, the spreads are equidistant, meaning both put and call spreads have the same width. All right, so let's do a quick option scan and see what comes up. As you can see here, we don't have a lot of choices, and that's because the markets have been moving quite a bit. But we do have Upstart Holdings, and this Iron Condor suggests a 71% chance for keeping the entire premium. On this trade into its parts, we'll talk about the profit, loss, and break-even conditions like we've been doing before. Iron Condors only profit from the premium paid that you received. Again, the profit zones are defined by the short put and the call strike price. And we can see that right here. As long as Upstart's price stays between $22.50 and $50 by expiration, all legs will expire worthless, and the trade is 100% fully profitable, and you get to keep $114 in premium. All right, so the Iron Condor, because it's got 2 strategies built in, it has 2 break-even, taking the short put, and that's because we're combining those 2 the premium received. The break-even point is calculated by using the short strikes prices less the net profit received. For the break-even price to the downside, we take the $22.50 and subtract $1.14, and that gets us a break-even of $21.36 to the downside. Now, for the break-even price to the upside, we're just going to do it in reverse. We take $50, add $1.14, and that brings us to $51.14. So that's the break-even to the upside. As you can see here, the maximum profit zones are in green. The light green means that there's still profit, but not as much. Of course, any price movement beyond the break-even price and the trade will start incurring losses, as shown here in orange. Now remember, the maximum loss condition happens if the stock prices or the stock's price moves beyond the long option strike prices. Again, our long option strike prices are $17.50 on the downside and $55 to the upside. To calculate the maximum loss, what you'll do is you'll subtract the width of the spreads minus any premium received, just like you do with the other spreads. So the width is $5, and that's calculated by taking the difference between the two spreads, and of course the premium that we got for this trade. So we subtract that. So the maximum loss is $3.86 a share, or $386 for the contract. Now, that might seem like a lot, especially when the initial premium received was only $114. But remember, we always have to look at the probabilities. As I mentioned before, there's a 71% chance of you earning this $114 for the trade. And there's only a 12.45% chance of an entire $386 loss. I think those are pretty good odds, especially when you consider that you need to keep the maximum loss. You only need to keep the maximum loss as cash in your account, and maybe even less, depending on your broker's requirements for iron condors. And remember, you can do this as many times as you can afford and collect the income every week, every month, therefore multiplying your additional $14 income over and over and over and over. Now, there's one thing to note that's really important. If you're going to start trading multi-leg options, you're going to want to have a broker that is options friendly, one that's not going to charge you an absurd amount of commission to trade options. I've seen commissions as high as $30 to buy and $30 to sell just one. And for that reason, I like interactive brokers because the trade fees are very little and they allow me to attach orders so that you get one fill rather than two or more fills. And of course, the commissions are very reasonable. Now, you might also check out others like Tasty Trade or TradeStation and others like those, as the commissions can easily eat into your profits if you're paying too much. Now, no video about creating income with options would be complete without the iron butterfly. That said, this really isn't my favorite, as I haven't found a lot of decent opportunities with it, but I have to mention it anyway. Okay, so the iron fly, or the butterfly, is a neutral options trading strategy that investors can use to earn income from a minimal price movement on the underlying asset. So it's got to be, got to move into very small range. Traders will sell an iron butterfly when they expect low volatility in a stock or expect the price of an asset to remain stagnant within a specific period of time. So I guess you could use this on very boring stocks that don't move too much, but these days I don't know very many of those. All right, so the iron butterfly combines two different options trades, a short straddle and a long strangle. A short straddle means selling a call option and a put option at the same strike price. And the long strangle means purchasing both a call option and a put option at different strike prices. By combining these four option legs together, traders can create what's called an iron butterfly position, allowing them to profit from limited price movement while also having limited risk. You have it plotted on a dotted price line. In this case, let's use Google. They're currently trading at $139, as you can see. When applying the iron butterfly strategy, the first thing is to identify the strike price for the short straddle. where you predict the price will expire. So let's say you believe that Google's strike price is going to drop to $131, let's say, in a month's time. Let's say you've got a tip. You know this. This is something that you think. So here's what you could do. You could sell the $131 strike call option and collect $2 in premium. You could also sell the $131 strike put and collect a $10 premium. You can also buy the $133 strike call for $8.50 and buy the $129 strike for $2.50. This gives us a long strangle and a short straddle that's both $2 wide. Let's see the scenarios and the income. So the income is $1 or $100 for the trade. Iron butterflies profit through premiums. The maximum profit is achieved when the asset price ends right at the short options strike price at expiration, and in this case, it's $131. If that happens, the maximum profit is calculated by the premium earned less than premium paid. So in our case, it'll be $1 per share or $100. Now, like the iron condor, the iron butterfly has two break-even points, one on the downside and one on the upside. But again, you don't want to be fiddling too much with these trades because it's going to cost you, probably just going to end up losing more money. Now, to calculate the break-even price on the downside, we're going to take the short strike price and subtract the net profit. So that's $130. As for the upside, or the break-even price to the upside, we add the net profit to the short strike price, and that makes it $132. Now, the iron butterfly has a limited loss range, and the loss condition happens when the asset price moves beyond any of the long strike prices, so $129 or $133. And with this example, we can calculate the maximum loss by taking, again, the width of the trade and subtracting the initial premium that you received. That makes it a maximum loss of $100 on this particular trade. Unfortunately, though, I think iron butterflies need a little too much precision, and for me, it's not something that I like. But a lot of people do like them. A lot of people do trade them in certain markets. So, feel free to go ahead if you like to. One thing about using an options scanner like Option Samurai is that you can set alerts for trades. So if you have a favorite strategy and there's nothing that is coming up right now, when a trade becomes available, they'll notify you. Like if you wanted to set up an alert for an iron butterfly with an 80% chance of profitability, well, you might only get one alert a week. And when you do get the alert, remember, you're going to have to act fast and make the trade. All right, so last but not least, we have the protective collar option strategy, and this is also known as a married put. Now, this is a popular setup that investors use mainly to protect their stock holdings from potential downside risks. But at the same time, they also get to generate a little income. So it's kind of like having your cake and eating it too. To start, the investor will sell a covered call on a stock that they already own. Then they're going to take some of that money that they earn and they're going to buy a put option with it and keep whatever is remaining. And this creates what's called a collar around the stock position. So the income potential is limited, but you also get downside potential as well. Let's say that you just bought 100 shares of 3M. It's a dividend king for $89. So that's your entry price. You want to keep the stock long-term, but protect yourself from any significant price drops using a collar. Again, this strategy is more about protection than creating income, but it is possible to generate a little extra income along the way. So here's how it could work. Now, 3M's recent 52-week low was $86.33 a share. So we'll buy a protective put with an $87 strike price. And this gives us downside protection on 3M for anything below $87. Now, the latest options info that I've got here from barchart.com, it tells us that put options with an $87 strike price that expires the end of October cost about $1.15 or $115 for the contract. At the same time, we want to write a covered call that covers the amount that we paid for the long put, maybe with a little extra on top. Now, the general rule of thumb for selling covered calls is to set a strike price or the level where you'd ideally want to sell it at. So maybe you're okay with selling your 3M shares for $94. Taking a look at call option prices, we can see premiums for the $94 calls that expire at the end of October. Well, they go for between $1.30 and $1.35. Now, let's talk about the profit and loss profile for this trade. Since the short calls premium is higher than what you paid for the long put, you get this upfront profit, and that's $7 in income that you get to keep. Now, this might not seem like a lot of money, but remember, you're essentially getting paid while having your 3M shares protected from steep price drops. The only downside is if 3M's price climbs to above $95 at expiration, well, in that case, your covered call is going to get assigned, which means you're going to be selling your 100 shares for $94 a piece, but it'll net you $507 on the trade. Not bad, right? All right, so calculating a protective caller's break-even price is also pretty straightforward. The break-even on a protective caller is whatever you paid for the stock plus any premium that you received. Now, a protective caller's loss scenario happens when the stock price drops below the long put strike price. So let's say 3M stock price tanks to $79 at or before expiration. If you were holding the stock alone without any downside protection and decided to cut your losses then and there, you'd have a paper loss of $10 a share or $1,000. But since you're holding the $87 put option, you've got price protection when the stocks go below that point. So your loss in this case would only be $193. And it doesn't matter how low the stock goes, it could go to zero because your loss is capped at $193 in this trade. Now, I don't know about you, but I would take this, $193 loss over $1,000 loss any day of the week. What about you? What do you think? So that's what I've got for you today on income generating option strategies. What's your favorite trade from this video? Oh, and again, I can't stress enough how tools like Option Samurai and Barchart can enhance your ability to trade options. Remember, you don't want to be gambling. Trade to make money. Limit your losses. I hope you picked up a few things today. And of course, like usual, I'd be happy to answer any questions down in the comments below. Thank you so much for watching, and I'll see you in the next video. Bye.